Hi, I'm Ross Mayfield, investment strategist here at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas chief economist Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to talk to you.
Good to talk to you as well. Hard to talk about anything but the topic of the day, which is the big tariff announcement this week on Wednesday. Obviously, a lot of ramifications, a lot of fallout. Let's start with Strategas raising their odds for a U.S. recession in 2025. Talk through that decision. What went into it? What are the primary levers by which the tariff announcement or the tariff policies can parlay their way into a U.S. recession this year?
Ross, this has been a recurring theme all year. So the increase that we made to put our recession odds at 45% for this year is the fourth increase we've had in those recession odds just this year. So not over the last 12 months, but just over the last few months. And so this has been against a backdrop of uncertainty created by the tariffs, the tariff announcements, but also something that has started to affect investment, started to affect exports, and started to affect other countries which might retaliate. So we have to put all of that into the package. Now, tariffs are really a policy that's all bad. You're going to get less growth with more inflation. And so the pathway that worries us right now is what's happening to corporate profits. So there could be companies that freeze in the near term, but if there's a sense that they could invest and do better in the future, that could help the company, that could help equity prices. However, what we're seeing is a consumer that is not interested in paying higher prices. So the tariff doesn't make it to the end consumer. It has to get pushed back onto the firm, onto the company, onto corporate profits. In that world, the company will then start to address their employment, their capital spending, their travel plans, their advertising plans. All of their business spending will come under pressure. And in that situation, we have to think that a downturn in the broader economy is becoming more likely.
So when we think about the tariff policy and inducing, a market sell-off and economic weakness, obviously this round of tariffs is much larger in breadth and magnitude than 2018. But in 2018, we saw a similar type of sell-off, and it was actually the Fed who came to the rescue a bit, kind of pivoting on their policy and ultimately cutting interest rates. Today there's obviously a lot of concern at the Fed about the inflationary impact of tariffs, but at what point is the Fed's hand sort of forced to come back to the table and ease policy because of growth concerns outweighing inflation concerns?
So, Ross, I do think we're going to get there, but I don't think we're going to get there very quickly. So, if we go back to 2018, inflation had been low and stable for a decade. Here today, we've come through a big wave of inflation. And so the Fed's going to be very attentive to inflation expectation measures, both survey measures and market-based measures. And there's some concern that you could start to de-anchor inflation expectations. So I don't think that's the most likely outcome, but the Fed will want to wait and see to make sure that they don't lose that part of the puzzle. And in that world, the Fed probably does cut interest rates. I think they could cut interest rates multiple times, but I don't think they can do it right away in the way they were able to a number of years ago. And so there's a cushion, but monetary policy is likely to be late. If we're looking for a cushion against the tariffs, it probably has to be fiscal. It probably has to be a tax cut or regulatory policy easing or lower energy prices. Those are available as well, and they may actually have to come first before we get the monetary policy impulse. I think the Fed really has to be certain that inflation won't run away from them. They don't want to make that mistake and lose price stability.
Yeah, I mean, obviously just stuck between a rock and a hard place here. When you're talking about potential offsets, other things that the administration can do to help ease the pain of the tariff policy, one thing that you've talked about quite a bit as a potential green shoot down the line is the potential for productivity improvement and productivity growth and efficiency improvements. to offset some of the cost pressures or some of the other things that might be squeezing companies' margins. Are you seeing green shoots on the productivity front? And does a shock like the one we're seeing now hurt that, or is this the kind of thing that can ultimately force companies to adjust more quickly than they might have otherwise?
Yeah, both great questions, Ross. So productivity has shown some early signs of improving, but the type of productivity gains we're talking about are something that should occur over a decade. This is not something we'd expect to see over 1 year, 2 years, even 3 years. If we're talking about structural change in the economy, using artificial intelligence, using technology in ways that are new, that should occur over many, many years and affect many, many companies. We've seen the investments into tech. We're buying the chips. What we need to see is the users of the technology also show profit gains, and profit gains in excess of what they might have done otherwise. So we're still missing that second step, but it is early. We wouldn't expect to see that just now. So while productivity is in some sense the opposite of a tariff, productivity gives us more growth with less inflation, offsetting some of the tariff problems. We can't rely on that in the very near term. In fact, the most rational thing for companies to do if they don't know the rules is to wait. So investment could increase productivity, but to get to the point where you're seeing that investment, even the investment start, you have to remove some of the uncertainty, and then it is a process. You have to build the factory, you have to automate the factory, you have to incorporate the new technology. So I think that's coming, but it's a longer term story. I would look for the fiscal policy cushions to be more immediate.
Yeah, that's a good framework. Fiscal near term, and then hopefully some help on the productivity side long term. Continuing, a trend that we've seen with expanding profit margins over the last couple of decades. Don, this has been really insightful, really helpful at an uncertain time. I appreciate the insight, and we'll look forward to hearing from you again soon.
Thanks very much, Ross.